G'day folks, it's Matt Hayson here as we close off the month of April for the property market. And let's be honest, it's been a month of total disruption between the school holidays, Easter and the Anzac Day long weekend that we've just passed. The market, well, it never really found its feet, but the numbers, they tell a deeper story. And right now, the data points to a genuine crisis of confidence in the market. Now, there's no better place to start than the final auction clearance rates for the month of April, with SQM research data pointing to a market that is adopting a wait and see approach, and the property prices are easing. On April 5, a clearance rate at just 33.23%. April 12, not a lot better, 37.38%. April 19, 37.85%. And last weekend, a paltry 28.54%. Now, these are the weakest auction clearance rates that we've seen since the COVID shock set in. Buyers are very much sitting on the hands of many sellers. Well, they're shelving their plans, hoping that a global conflict resolution will swing the market fortunes back in their favour. And that raises what we're hearing is a very common question in the market right now, which is, will conditions improve this year? Now, I'm going to have a go at this, and understanding the forecasting is a bit of a mug's game, but the headwinds point to a prolonged easing cycle throughout 2026 and even extending into 2027. This week's inflation print has headline inflation sitting at 4.6%, well beyond the RBA's target band of 2 to 3%. While the trim mean inflation, though, which is the RBA's preferred metric, was stable at 3.3%. That said, the cost of food, housing and transport were all increasing. Treasury is still expecting inflation to hit the mid 5% by June, and markets are now pricing in a 75% chance of a rate rise next week when the RBA do make that announcement on May 5. And almost all economists are forecasting the RBA will lift the cash rate to 4.35% next week. Then we have the federal budget on May 12, and the private sector is urging the government to cut spending. And the two most common words that we're hearing in the economy right now aren't good. They are recession and stagflation. Now, economist Christopher Joy believes a recession for Australia is almost a fait accompli, and stagflation is certainly a real risk, which combines rising costs, tick in Australia, weak economy, tick in Australia, and rising unemployment, and the signs are certainly there. So everything points towards rates rising further throughout the course of this year, and if we do see further rate hikes, many are expecting that to occur in August, all of a sudden borrowers, they are going to be assessed at a serviceability level nearing 10%. So that is the framework that's in play right now. Also, interestingly, this week, Money.com released new modelling for Australian house prices stretching out to 2030, with their best case scenario showing values up by 23%, but that relied on no further rate hikes, and that isn't going to happen. Now, their most probable was a decline in values of 11%, factoring in up to 3 rate rises, and their worst case scenario, a crash of 40%. We've heard this before. Now, 40% is alarming, and I don't see that happening, but if we look at our closest economies of New Zealand and also Canada, then both have seen 20% declines in their property values from their market peaks. So the cold-faced reality is this: 2026 will be a year of price falls for Sydney. For those thinking of waiting until later this year, the data simply doesn't support any rapid improvement ahead. So, in our view, why put your plans on hold? Buyers, you also misread the pattern of how quickly our market shifts. And since mid-March, many regions and property categories have seen an immediate price correction of 10%. So there is a reasonable chance that we are already at the bottom of this market cycle right here, right now. So my assessment for this week is for sellers to meet the market. It is simple. Many of you, and most of you in fact, are buying and selling in the same environment, so the net impact is quite negligible. And for buyers, proceed with caution, but you must act. The smart buyers that we are seeing right now are offering what we call a safety number. They are pricing in that future market risk. So, in our view, this will be an extended cycle. 12 to 18 months appears to be reasonable until we see a material shift in conditions. With all that said, let's see the activity lift. We can all read what's going on right now and what's in play, but don't pause, because opportunity is abundant right now. So that's what's going down in and around the property market this week. Plenty going on as always, and we're launching some amazing homes, and I look forward to catching you all next week.